All right, so let's take a look at where we ended up here. Yesterday into the close, if you remember, we were looking to get the bullish position that came in up and trying to liquidate the bears. Let me just show you where those guys were. All right, let's get rid of that arrow. Right here, these bears who showed up, decay popped over. We had some trapped orders right there. The bears hit. It was premature or out of structure. They didn't get approved to take that position. The controlling party had not moved out of the way. They jumped in. We could see that they hit here, and they also were able to impact tension. So we know they hit with everything they had. The rest of the day basically was just moving down to get our zero test right here into this low. And the expectation was move up to this level that I have marked here, which is right over this little peak. So waiting until that. The first wave happened here, and we were able to push up. And then it was committing to the next section of pain and suffering while the whole trade worked out. So this morning, that's where we were when we opened up. So the market opens up, and you can see right here, decay moves down. The bulls get liquidity and do not hit. But this was very similar to the previous day. So if you're watching this in real time, what you were thinking about was tension. You should have been paying attention to tension this morning. You should have said, oh, okay, so tension just popped over zero. This is a zero test for the bears from below a little bit. And the bears did what they could, but there was no liquidity here. So the bears were trying with whatever they could to hit this down. The bulls want to pump tension up today. And I think as this moved down, we have that sample. You'd look at this and you say, okay, well, I think they're looking at this zero test, which is exactly what happened. That was something to pay attention to, but they didn't hit. So in this instance right here, this is the thing that these bears from yesterday needed and didn't get. So the bulls fail right off the open, and it leans the market down into a zero test. And this is a similar situation to yesterday. If you remember, the bulls didn't hit yesterday, and the market dipped down and had the zero test. They didn't hit today. It dipped down and had the zero test. We got the exact same set of events that we had yesterday this morning. It should have looked very similar to you. The market dips all the way down, has the zero test, immediately turns back up. You see the trapped orders right here, way down on the low, essentially retesting the area. We closed up this expansion bar here. We also were able to, let me show you. And this is obviously but we were able to close up that gap to almost to the tick. This is perfect. Closed up this gap, and it moved up. Then we got a break back inside, a retest of the value area low, and it moved up. So this is important because this helps us know what's going on. So that happens, it moves up, tension pops back over zero, and right as we get back over zero and we start to move up, right in here, I think it became pretty clear what was going on. This is when things got clear. The market was bullish. You should have said to yourself, okay, we got our dip down, we got our zero test, we got some trapped orders right in the low at that zero test, and it's going to function like liquidity. It pops back over zero, we get back up. This, of course, is going to be an issue for the market to deal with. This is the failure by the bulls, who are the controlling party, where last time you remember the bulls hit, yeah, my camera's not covering it. They were able to hit price. So you see them pick up, they hit the bid, they hit, then they start pumping that up, they put the money in there and price moved away. So that's the hit, but their impact, they had no impact as the market was leaning down. And today they didn't hit or impact. So this is going to be a little bit more difficult because this is a position that got turned upside down, and the bulls were hoping to use it to pump the market. But really what happened was this position got liquidated. You see the acceleration in tension, and that liquidation led to the zero test. And in that way, it was essentially open interest theft on a large scale. This is a big open interest theft. It was a big player to a big player right at a zero test where the bigger fish picked up the zero test, defended probabilities, and drove things out, stealing a pretty decent sized position. Yesterday, that didn't happen. This is a really interesting low. I think it establishes a pretty strong precedent in the market that the bulls, the bigger bulls, the ones with a lot of money, so they came in this morning. This narrative, I think, is really important right here. Understanding how this developed, where we took this position out, we got our zero test, we picked it up, popped it back over, it all happened, and now what are we looking for? Well, as it moved forward, you could see these bulls needed to find some more bears. There was a couple of things in the way. Decay needed to push over zero. There was a zero test here too, but I think that this was more important, the way that it accelerated down and was able to pick that up. But that zero test did happen right below. So it was really just a lot of bullish things happened right in those lows, and I think it's a big deal. This was the market bigger fishing. This was a bigger fish situation. We stole a position from an institution. We had liquidity in the low. We got our zero test. The zero test was defended. Everything popped up. We moved back up. This is kind of how I'm looking at this. While it was happening, it was like this is yesterday all over again. Maybe it was just me, but I looked at it and I said, this is yesterday all over again. That was this again. It was very similar in terms of what was going on, how it worked out. It looked similar. I don't know that matters to me, but it did. All the events sort of had this echo to it. It was like this is yesterday going at it again. Because yesterday we were looking to see if this could get up to this level here. And I think we're just in the same boat. We're going to do the exact same thing. But today we have the time to actually pull it off. And we had some more aggressive bullish activities that were successful on in this market. So I think this is a really interesting event here to have these two positions back to back that are such strong bullish positions, having the bears really get themselves trapped in a position here, which they may have hedged. I doubt it. I don't think the market, if you were able to hedge as a bear, I think this would have been the only time when you really thought that you should. I don't think these institutions really realized they had a problem until here. I think these guys right here sat and they waited and waited and waited, and I don't think it was really clear there was an issue until here. So if they were going to hedge, this would have been the spot to do it. The market came back down, retested that spot. I think there were a lot of shadow bears because I don't think this was really great structure. In terms of liquidity, I think there were shadow bears here who were picking this off. So I think there's people to wipe out on a pretty big scale. I think there's a bunch of orders that are just going to get obliterated as this moves higher. They're going to help these bulls pay. Okay, so that gets us to about here in terms of narrative. Okay, so this is where I am walking through this narrative in my head. If this is a story, we just got through the first. So as this moves forward, the objective here is to push decay up, see if we could find some bears. We found the bears right here. Decay pushed over zero. There's our trapped orders. And you're sitting there going, okay, the bulls just defended zero again. They were able to pick up a lot of interesting positions that are good. The conflict was pretty good. It's risen enough. We have people upside down. Are these bears going to hit? And I just don't think so at this point. We've established the bulls control the market. They did a great job with structure yesterday. They picked up a complex position this morning. It's successful. And if you notice this green line, which I left on here, which starts here, is the bullish, the original bullish position from 2 days back, Wednesday, where things started to get interesting. And I think this is an important position. And you can see that it struggled to get over that position yesterday, finally got over it. And then we had one dip under, and now we're over that position. I think essentially the bullishness in the market is here, and it's going to stay. And I think that these bears, this is not a place to expect the market to come down. The bears had their chance to defend this. They even were able to take out a bullish position. So at this moment, they're going, Well, we had a bullish position. We could have run it further and liquidated more people, maybe even yesterday. That would have been great. But you failed. You failed to defend the market at a very fundamental level. You failed to take out those bulls. You basically just handed them over to a larger group of traders. You failed to grind the market in any way, holding, carrot the market, put a carrot in front of people and drive it down, which is essentially when you squeeze somebody out. Their defense of tension was at best shadow bears. I don't think that these were great. So at this moment, no. Your best position was yesterday, and it was horrible. This position was terrible because it was out of place. It was out of context. It was poorly put together. No. These bears are fodder for the move up. And this is, I think, the goal. I think that's the objective here, is to get us up to that position where I think essentially all these positions along the way are going to let go of their trades. This is still yesterday's bull playing out. We got our first leg up, which was this one, and I tried to explicitly go over how that was the first leg while it happened. I'm a first leg impulse trader. I don't really like swing trading because it can be more complicated than you want and take more time than you want. First leg was done. I tried to explicitly say that, and I hope I made that clear, that if you commit to the trade, you need to understand what that means. It's a whole new thing. This would have been very difficult if you were holding on to this, especially if you didn't get a really great position. So I think this is just a continuation of yesterday. I think that the market sort of opened here and the institutions were like, oh, let's go ahead and get a bigger position. Why not? And it dipped down, picked it up, came right back up. We just did this again. Why not? And then we were able to pick these guys up here who are going to help pay for a rally higher. And you can see it dip back under. Here come some bulls. Are these bulls going to hit? Well, they should. And they did. They held their position. They were able to move things up. So you could see at this moment, and we're to here. So we did Act 1 would essentially be here, Act 1. This is Act 2. Act 2, we're looking for bears. We're trying to see what's going to happen here. Are they going to hit in response? No, they shouldn't. They absolutely shouldn't. And if they had, I think this would have done exactly what I was thinking yesterday, which is that hitting the market down is just going to fold all your capital against you. You're putting it at risk poorly. You're going to get fired from your job. That's what it would look like to me. So we have the bears show up here. The bulls show up right on the backside. So this is a switchback. Are these bulls going to hit? Yes, they should. They absolutely should. And they do. They defend their position. Why should they hit? Why am I saying that? Well, we can see that they defended everything. So I'm sitting here saying, I think their intent, it's not that it's like success here means success here or success here. And it is sort of that. But really what it is I think that these hits together imply the intent to get to here. Yes, they have been hitting. So yes, you should expect them to continue to do so until it breaks. But I think the way the market structure tells us the intentions. The intention is to get us up to here to wipe out all of these positions along the way. My face. So I think we understand the intentions of the bulls, and this is the data you want. It's not that you want to know they picked up liquidity. It's not that you want to know that they hit in the dark pools. It's not that you want to know what their position is. It's significantly more important to know what they're trying to accomplish because they can, and they pretty much always get what they want. So I think we see the intent of the market. I think the intent of the market is to wipe out all of these bears who came in on everything after basically Thursday. And then Thursday needs to reset itself because Thursday was the day with the hands in the air. Nobody wanted to play. So we're going to head back up there, take out anyone who chased the market, and try Thursday again. And that's going to be Monday. My expectation is that on Thursday, we see bulls hit moves up into the bears. I think we see aggressive bears show up, get turned upside down, and shoot this higher, because that's what we were looking to do on Thursday, and nobody played. So I think we're doing it again on Monday. And I think this market has made it pretty clear what its intent is. We defended the probabilities. We're slowly making our way up. We have a couple of groups of people trapped in. I think we have a pretty clear, I think there's a decent place to get to where I think all those bears would let go and they'd unwind their position, detach themselves from their capital, and in doing so would help accelerate the market higher and pump tension up. We have an hour and 15 minutes left in the market. I think this is the objective, is to do whatever we can to get this up to this area or close to there into the close. And then on Monday, we retry Wednesday's market again. So you can go back, take a look at Wednesday, how they positioned, and say to yourself, okay, what were the bulls doing? What were the bears not doing? And then I think the bulls are going to try and basically do the same thing again on Monday and see if we can get some bears in and get a directional market. Because if you remember on Wednesday when it gapped up, we were kind of looking for a gap and go. That's what we were looking for. On Wednesday, we were looking for it to pop up and a gap and go. Now, gap and goes tend to do a nice arch. This tends to be the way that they end, is a curve. It's just my observation. You see this a lot. And we did see that, but it was like a gap and go and then a little tiny arch, and then it moved down. And I think that basically we had this tiny little curvature here because there were no bears getting trapped in, so the market just sort of slowed down and lost its steam. So Monday, I think we want to try this again. Let's see if we can get a gap and go moving. Let's see if we can get those bears to mess up and drive this through the roof. Just straight up brand new highs. Let's just go right on ahead. We already took care of the revenge traders. We already wiped them out. We already frustrated them to the point where they walked away. We've trapped in a bunch of bears. Those bears are upside down. They have targets. Everything's lined up really nicely to see this just pop up and get us through the highs. That's where we're headed. I think the market's made its intent clear. And let me be clear about this. I'm talking about pretty much the entire week here. When I say the market's made its intent clear, and when I say I think this is going to grind up and hit that place and we're going to be looking at a market that wants to gap up and move, I have 5 or 6 days worth of analysis in my head when I say that. I'm looking at this week, and the way that it worked and the way we're structured right now tells me the intention of the market. And I think that's the data point that is the most valuable in all analysis, the intention of the relevant decision makers. And I think we know what it is. I think it's pretty clear. So do with it what you want. Make sure you use your strategy that you have, and you use it in the best possible way to take advantage of the narrative that I think is going to play out over the next, into today's close and through Monday. So that gets us to about here. We've gone through. We have the bulls show up, they pop this up. Okay, so maybe about here, and you can see that this little move up here, which was them, it did move up. These bears, they're stuck. So we can mark out these positions. I'll mark them over here on this ES chart so we can see. So the bears came in, dipped down, pushed up. It's this pivot there. Okay, we have our bullish position down here. We have another bullish position right here. So this is where people are positioned, and I think there's a pretty clear target. I'm not sure how to be clear about this. I think that the intention of the market is the most valuable thing. And I'm trying to tell you, I think the intent is extremely clear. I do not think this is vague. I do not think this is abstract. I do not think there is any duality to it. I think the market has told us what it's doing. We are going up to 322. We are pushing through there, and we are going to be making new highs on Monday. It's not ambiguous. It's clear. I can't stress this any more than I've done. I think it's important that you understand how the conclusion was come to. Sort of like if you hear the story of Goldilocks and the Three Bears, and I say, she's going to eat the warm one. It's like, well, what? Like, you need to understand the narrative to understand the outcome and why that outcome is meaningful. If you don't, if you can't understand how this conclusion was come to and how this all structured and how it's set up and how the bulls pulled it off, you don't understand how trading works. You have to understand how they pulled it off in order to understand where markets are going. I think it is absolutely fundamentally silly to think that data points that give you a statistical outcome can tell you how the market accomplished something. If you look at like politics, the question is how do you get a law pushed in and signed and function? It's a very complicated process to actually lobby and push a law through the system and get it to work. It's expensive, it's difficult, and if you don't understand how it works, there's absolutely no idea you're going to know which laws are going to get pushed through, and you have no idea even what they mean. I think it's just a silly thing to say. Well, 5 times out of 10, a law goes through. Sure. Okay. 5 times out of 10, a law goes through. But if you know the people, the politicians, who's sitting, on like the Supreme Court, how all the systems work, who's the president, what the climate is, have they made America mad? Is America happy? Is the judiciary system? It's a big game. And I think this is similar. You need to understand how this stuff works. So as things like today's big events are happening, you can say, oh my gosh, it's clear. It's like, we're there. We have it all set up. They structured it right. They're playing this game right. We know where they're going. We know where this is headed. It's no longer ambiguous. It's just not ambiguous anymore. And I think politics is a pretty similar game to play. Another good example for anyone who wants another analogy that's not but politics is kids. Like, if it's your kids, you see problems developing and you know exactly where this is going. But other people's kids, it's not as clear. So I can come in with exactness and know where events are leading to with my kids. Your kids, I might have some good hunches. The point there is that it's a very complicated social structure that has a lot of things that if you're not familiar with, it's difficult to see where things are going with certainty. But if you're very familiar with it, you can see where things are going with certainty. That's where they're headed, and you're right. And those two things need to come together, where that you could say, I see where it's going, and I'm right. So unless something dramatic happens, unless there is some real world drama, the structure here is clear. They've made it clear. We don't just have regular institutions. We got bigger fish institutions, which means that the folks sitting here are a degree greater than the typical institution. They came in and converted an institution into liquidity, not just retailers. They let the retail market generate a whole bunch of orders to give to the general institution market, and then they took the institution market and they put it into, I say RD, which is relevant decision makers, which is a debate term. And they turned these guys into liquidity. And I think these are bigger fish. That's what happened. So I think we have some real support here for this intention. And I think it's pretty clear. So unless something dramatic happens, unless the world does something, which I don't know why you would do that. Like, if I have a whole bunch of money and I decide to dump this in, this is how far you have to move the market. So you're going to have to get through this. You're going to have to get through this before these guys decide to start liquidating and these guys decide to start liquidating. This is what you would have to pay for. So whatever the cost of this is equal to the strength. Because nobody wants to pay for that. Because if you don't pay the entire amount and get it done, and then there's this question about once you get down to the lows, are they going to let go or are they just going to add and shove it back up? So there's some doubt down here that if you push it down here, you actually need to keep going down or they're not going to let go. So unless you pay this entire amount in entirety, this will go like this and you will regret putting that money into the market. So this is the strength of the market. It's the fact that it's so unreasonably expensive. Nobody's going to do it. And so it's strong. It's not because angles and direction and things. It's because it's just too expensive to break. Now, if somebody did it, that's a big chunk of money, and I would take that extremely seriously. That would tell me the major. And when I say major, I mean like monthly. So we're looking at least, if you're looking at trends, you're looking at least a daily chart. But the overall overarching trend, which I think can be seen pretty clearly. And when I say monthly, I mean like over the course of this month, not monthly bars, because that's just way too zoomed out for me. But daily here, I think that trend would be broken. That's what I think. I think it's pretty clear what's going on. I think everything's set up. This is, in essence, a AAA play, and the AAA play has been hit. It's a AAA hit or structure. It's not just a hit. This is structurally built. It's built to do the thing that we're looking to see it do. If that falls apart, watch out. Right at the beginning of the pandemic, I remember seeing something similar to this, and it broke. And I remember the feeling I had, just like, oh, this is a problem. It's a huge deal. Because it'd be like you taking your car down to get it fixed, an old broken car down to get fixed. You go down, they basically make it brand new, give it back to you, and nothing works. It's just like, what? That doesn't make any sense. There's a brand new motor. The mechanics were amazing. The tires are new. You redid the whole body work, the chassis, the brakes are great. The gas line's perfect. It was all worked over. Everything's perfect, and then it doesn't work, and it just all falls apart. Your whole world view should shatter in that moment. You're like, this doesn't make any sense. Why did everything that was done well and correctly fall apart? And the answer is because everything changed. Not that you're wrong, it's that everything changed. It's sort of like you're standing on the ground and the ground shifted and you fell. That's what happened. So in my opinion, we have this ground that's built under us. We have the AAA setup. I see all this stuff. So if it fell apart, if somebody footed this bill, if somebody did this, look out. Just look out. This is going to be a problem. You might say to yourself, well, what if there's no players here? What if really this isn't happening? Well, I don't think that's true. I think that we have tension pushing over. We have the trapped orders. You see the volume. They were able to bring price down and hit out of that volume. Everything lines up. Yesterday's was even better. We could see the trapped orders. This can't happen unless it's real. Decay moved positive. That can't happen unless the energy actually moves. And they were able to hit price out of it. So structurally, the whole point of this analysis is to make sure that we're not getting duped about data points. So I don't think that's sensible to think at this point. We can see them. We can see it happen, whether they want us to or not, whether they hid their orders or not. We can see them. They are here. So I think this is, in a very real way, set up this way. This market is designed to go up, get to here, and I think look for a gap and go on Monday. So if it breaks, if it all comes crashing down, we have the players. We can see them. We see what they did. It is set up this way. If it breaks, I will be really concerned. And I might even start to say, this is our major pullback is about getting in place here. So if you're going to look at this structurally, and if you were sitting around at a table, with a bunch of military soldier people, and you're all looking at the strategy and trying to beat each other at this strategy game. If you're a bear, a very large institutional bear, you should be looking at this going, oh, this is the moment. The bulls are here. They've done all this stuff. If we just break this down, this could bring in the bearish market that we're looking to try and happen. And I do think, the market did come all the way down and all the way back up and was just relentless on this rebound. And I do think we've sort of taken out a bunch of people and do a little spike up and market like that. That'll be took out a bunch of people, and we're sort of in this, conceptually, we're sort of like, I think everybody got hurt. I do think a move down would have a ton of backing, just a flood of orders. And so I can see how that a bearish person or institution would say, well, we just have to sort of get past that breaking point now that we sort of eliminated everybody who was trying to short this idea. All the way up, people kept seeing a move down that was going to keep going. They're trying to short that. They finally got blown out. Boom, now they're not in the way. Now we could move back down and look at some sort of pullback on that move. So I could see an institution absolutely seeing that as an option right now. I could totally see that, because we would get a ton of backing as people flood in and go, oh, okay, here it is, blah, 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 and it would move down. So I want to point this out because like I was saying, like, this is a very expensive move. It just is. It's going to cost money. You're going to have to just put the money in, and you're going to be breaking through things that I think structurally really support the market moving higher. But if it happens, that would be a big hit for the bears, and we could be looking at some bearishness coming into the market through next week. I would be looking like a week or two out, thinking that that's what would be happening. So I want to model these both directions, and I want to make it clear that I think that the players that are working the market right now are not the typical day-to-day people. I think that the people right now looking at the market are sitting here thinking to themselves, where are we headed over the next month? Are we going to go up higher, or are we going to move down lower? And I think structurally that the institutions have told us this is moving. We want to go up. We want to move up. So if you're sitting at the table, that's the arrangement that's gone on right now. The thing that needs to happen now. So I've sort of, we went over the narrative. Hopefully, you got, this was the first spot. This is the second spot. Now we've gotten up here as we're starting to move up. I think this is in the card. So what do we need to see next? John says, a bit of a surprise that ES not moving much with implied VIX coming in. John, I would think that the bulls would take this and run, liquidate counterparty and drive trades. Okay, so John, I want to point something out. When you know for sure, when you have a really good game plan, what you do, so let me show you. So if you've got the chance, you're in a boxing ring, you got your guy up against the corner, you're gonna win, absolutely. You know he's going down. What happens is you want to get from A to B, right? Let's say B is where you win, and A is sort of, you're in the middle of it. But you can pretty much see this happening. What happens here, I think, in your head, is that you have this, in psychology, it's I forget, it's a knowledge gap. I ran out of room. Knowledge gap. A knowledge gap is where that you know thing A and you know thing B, and together they would make thing C, but there's this gap in here. And there's this natural mental pressure that wants to shove them together as quickly as possible. You want to take time and you want to reduce it down to 0. So you want time to equal 0. That's what you want. And your brain's trying to say, let's eliminate the time in here, and it says, let's take the work and let's shoot it up to infinity. Anything you ask, I'll do it. And this is knowledge gaps. Knowledge gaps create this impending pressure. It's like a cliffhanger. You just go, I need to know. You want to drop that time to 0, and your workload goes up, and that's what gets people to pay a lot of times. You gotta close that gap. And so when you have your guy up against the, in the corner, you beat him, you want to beat him quickly. Just take him out. This is the natural bias. And the markets know that. So what happens is when you beat your guy, this is what the market wants. This is what you give them. So you slow it down. Why do you slow it down? Because all of this time in here is what I like to call emotional juicing. This is sort of an older philosophy, but it's the grind idea. You know it's going there. So all along the way, why not dip it down and catch people along the way? Make it as painful as possible. Essentially what that means is that if you're holding long right here and you know it's headed here, make it painful, meaning make it so all the bulls hate it. Essentially, when bulls hate something, bears like it. And that means that along the way, you can pick up a bunch of bears who like it, and they get grinded out of their position over and over. I think that a nice slow move up is more indicative of strength than a fast move up, because a fast move up suggests that you actually need to move now. And there are times when the market runs out of time. It's like, you got to do it now. I think that because it's so clear that the market's going to try and play just as many horrible games as it can along the way, because I think there's a high level of surety. So there's some security here. The bulls and the security is that bullish investments will work. So that means, penned orders pull the price down and it'll shoot back up. That's okay, because you have this level of surety that you know that if you shove it down and all your work to make that happen is going to pay out. So it's okay to put extra capital into market playing games with people. And I think that's what causes these grinds up, is this security that comes in for one side. Yeah, it gives them hope, so they move their stops. Yeah, John, you're right on the head there. And in this situation, I think that a quick move up is what we want, because we're going, okay, here's A, here's B. And we want to drop the time. We want time to equal 0, and our workload goes up to like infinity. And you have to be careful there, because you're willing to do a lot. You want that, so it puts this pressure on you. And then when you see things like dipping down and sweeps that go against you, these aggressive moves, you question your worldview. And questioning your worldview is essentially saying, do I actually know what's going on? So if you see the market move against you and you're like, oh my gosh, I just lost money, that must mean that I'm just wrong because I'm stupid. And those are the things that pop into your head during those moments. You start questioning whether you have any idea what's going on. And if the market can convince you that you're blind and dumb and you're just making it all up and there's nothing here for you, then you'll let go and you may not come back. And that's a good thing for the market. I know it's a good thing for the market to shake people who know what's going on. It is a great thing, because those are mouths to feed. And that's expensive. It's easy to take care of people who are uninformed, but people who can pick up what's going on, they consume some of the funds that the market is paying out. And it's great to shake their worldview and get them to leave. It's a little hard to keep them permanently out, because if you get shaken out because of a dip or something like this, and then the market does do what you want, then you're going to come back. But if we can shake you out for this move, then this move can look good. So there is investment money in every good trend specifically dedicated to knocking out informed traders by shaking their world view. And their world view is essentially the way they've modeled where we are and where they think it's going. World views are built on goals. You're here, you see some world out here, and how do we get to this world? This will be the planet. It's the world. And it's like, how do we get from here to there? And it's built on goals and the way that the methods that we get there. And if the market can say you were wrong, then you become blind and you can't see the future and you feel dumb and stupid. And the whole point is to get you to distrust your worldview, the way you see things. And I think there is specifically money dedicated to shaking worldviews. I really do, because that's what I would do. If I hired a psychiatrist and I hired a physicist and I hired a bunch of people, the psychiatrist would say, shake their worldview. The physicist would say, here's how we could do it. An accountant would tell you how much money it's going to cost. I would have this team of people together. And that's if I had that kind of control of the market, that's exactly what I would do. It'd be a wonderful game plan. Shake out the people who are taking funds while you trap in people who are uninformed. It's just beautiful. So I think that's where we're at right now. The market is trying to shake people's worldviews. And, we've seen grinds before. You know that grinds look like this. You have these little pops down and stuff like that. And these sweeps down, they convince a lot of people to try and sell because they're like, oh, there it is. It finally broke the trend line. But it was just intentional jabs at further funding and bleeding the market up. So now we've gotten through all this stuff. I've given, we have the narrative. I think we have intentions. We've built out some goals. So where I think, that's sort of intentions, but we sort of know where the market's going. So what's the immediate future looking like right now as we move up there? Well, once we get into this situation where we kind of know all this stuff, the first thing I start looking for is inversions. An inversion and I like to model this from a businessman's perspective, and I know you guys have heard me say this a lot, means that you put in the money, right? Money in, no work, profits. It comes down to this. The investments are in the market. The investors don't want to actually do any work, which work in markets is carry risk and position and stuff like that. And then they want the profits to roll in. And this looks like an inversion. So I always look over here at these charts. Yesterday had a 1050, which we didn't push over, and that's about here. I don't usually use multi-day, but I'm just gonna draw that out because it's just something I'm keeping in my mind. We had a 767 on the tick right there. We were able to push over it, but we just pushed a new high, which I think the tick could do a little bit better than 800. But what this means is that it cost a certain amount of stocks here, cost about 700 stocks upticking. And to push this move, it cost 800 stocks upticking. Now, this is not accurate. What I just said is not technically accurate. There are not 700 stocks upticking at the same time. That's not accurate. But it's the way I sort of think about the way it works. I think of upticking as like money. It cost pushing 700 stocks up here, which it didn't work. And then we were able to get this section here for less than 700 right here. This whole move up cost less than 700. Otherwise, we would have seen a new high. And then this move up, it cost more than 7. So this move up here was more expensive right there. And when I look at this and I'm sort of modeling this situation that we just talked about, I'm thinking, well, I want to see this moving up and it gets pretty much the cost goes down. So I want to see the tick going down on these new highs and stuff. And I want to see the price going up. So we're getting the profits while the cost, which is moving stocks around, while the cost goes down. That is a great investment in my head. You want to put your money in and your costs go down while your profits go up. That's what I want to see. That's what I like to see in this situation. You could see that we just had a cost spike. I like to see inversions off of things over 1,000 or more with the tick. I also like to see inversions where you have prices move down. So these are just general rules of thumb, just to be clear. So general rule of thumb number 1, I like to see inversions with 1,000. It's not money, it's ticks, but 1,000. I also like to see them out of more than I like to see them into. Okay, so this one is into. You see how we had the high into the low? It was on the wrong side. I wanted to see it right here, out of the lows. So those are the two things that I like. over 1,000, and I like it out of, I want the inversion on the way out of a low, not into the low. And if you watch this for a month or two, you just pull up the tick and compare it to the ES, you'll start to see what I'm talking about. Okay, so that's where we are. The immediate future, I'd like to see an inversion set up in some way, somehow. Don't really care how, just as long as it works out. And then the next thing we need to see is to start to see bulls pumping tension. This needs to happen. We're still kind of close here with the 7%. That if the bears did get sort of crazy, there is potential they could get that 30-minute under. So we have the intentions in place. We have a pretty decent strength behind us, but structurally there's still a couple of bricks that need to get put onto this house. We got to see this move up. And this acceleration is going to be the direct result of wiping out these positions that we have been tracking. Whoops, that's not the right one. No, you can't see it. This one. These three positions are the main. There's some other ones I think you probably could track here. Well, so if you're having questions about this one, there's two things that make this there's two things that make this liquidity right here a little bit unique. Two things. First of all, it's off the open, which this isn't one of the two things. So you always got to take that with a grain of salt. But one, we spent the entire day yesterday trying to get to zero. So there is a precedence. That we were waiting for that a whole day. We were like, okay, here it comes. Nope. Okay, well, how about here? Nope. And then we got a little faster. Nope. And so and then finally it opened up higher. So to me, it's not marked on here, but because of that precedence we had yesterday, I think that's important. The market was constantly watching for that. Well, at least I was, and I assume that I am the market. So there's a precedence here. So that crossed over zero, and that's the philosophy. You see it cross over. We trapped orders off the open. So this is one thing. Now you have to take it with a grain of salt because it's off the open. The second thing was there was a zero test. And that zero test right there. So if you're looking at that, you're going, well, how do you come to that conclusion that there were some bears there? That's why I'm calling them shadow bears. Because the liquidity was a little tough. It wasn't nice and clean. Right off the open is not the best place to hop in. But there was a precedent. So I'm thinking that these bears are not the institutional, well-informed, relevant decision makers. These are the bears who see what's going on and it makes sense. So I'm calling these shadow bears. So if you're having a question about why I'm tracking that as a position, it's because of the zero test, the precedent we had, and that's why I'm looking at that. Okay, the rest are all pretty straightforward. Those people needs to get out. That will cause this. So my expectation right now is to pump tension. No more bears. We are done finding bears. It's over. Quit doing it. I don't care about bears. I don't want to find them. We don't need to trap them. We don't need any more bears. None. It's over. The cards are dealt. The hands are in. It's over. I don't want to see bears. This is part of my expectation. So if the market's like, well, let's go see if bears show up, I would be going, I didn't want that. I don't need that. Stop it. In other words, you're failing to meet my expectations. The third thing, so pumping tension because we already have bears. Don't find any more. We don't need any more. And to see the market move in sort of a bleed. And we talked about that, these types of spikes down that lead to moves back up just because there's a high level of security when it comes to knowing what's going on. Move in terms of a bleed, and I want to see a liquidation of a larger scale. So, I think there is a ton of positions stuck, and that pushing this up would have a bigger than normal. It's like multiple days. Structure's a little bit broader. The intentions are a little bit wider. So I want to see a bigger liquidation. I would expect like a 4 to almost 10 point sweeping pop somewhere in this area where you're just like all of a sudden it just shoots up and everyone's like, oh my goodness, that was huge. Where'd that come from? Oh my gosh, that's amazing. Just something even the regular average retail traders are able to recognize. Because of the precedent here, I'm expecting a larger liquidation to the upside. That's what I expect. I do not expect, so just to be explicit here, this to move down, especially through this position. I do not expect this to get down here. I do not expect a move down and then a move back up. We already trapped in all the bears. We already did the pressure. We did the stress test, the retest, all the stuff that goes on. I don't expect that. That is not in the expectation. Could this happen? Sure, that's fine. This could happen? Sure, that's fine. I do not expect pressure on these positions. So we start to get that. I start to get skeptical. Okay? I do not expect the market to, and I said this, to try and find some bears. And there is occasion when I'll say, we need to find some bears. We got to see what they're doing. This is not one of them. I do not think we need to find them. I do not think we need to rewrite the story. I do not think any data points at this point really matter at all. All we're doing is getting from A to B. So I don't expect moves down. I don't expect real heavy trouble for the bulls. I expect this to move essentially in one direction into the close. And then I expect on Monday, the market to try and redo that gap and go scenario to some degree. Now, are we going to get actually a gap and go? I don't know. I don't know if it's actually going to gap up. What I mean is that I think we're going to go back to this here, and the market tried to hop up to this area, find some bulls, and run. So if we're up in this area, which, we're pretty close, then I expect the market to just try and do whatever this market was attempting to do again. If it's a gap and go, great. It doesn't actually have to gap. I just think we need to redo the gap and go day. Okay. Looking at this, I would love to see, as this moves forward, to see this expansion. You see we're expanding. So it marks it red when it's expanding down. It marks it green when it's expanding up. Expansion means the market is outside the value area. And it's pulling it. So price could move outside that value area and move. Let's see, I think we had one just a little bit, but right here. Okay, this is just a excellent expansion. So this is easy. Obviously, everybody knows this was expansion. But the philosophy here is that it's expanding the distribution, which we can't see it, so it looks something like that. And it's taking that distribution, it's pushing outside with lower volume, which obviously you can tell there's lower volume because the value area is not moving with it. Lower volume and price outside the value area. So clearly this is expansion. And then you can see times when it's like, just see right here. So you see the value area, it pushed outside the value area, was able to expand, that turns green, right? And then it moved back inside the value area and was able to get under the point of control, and the expansion is no longer a thing to watch. I mean, it's, it needs to kind of stay outside there. And that's how that triggers. So right now we have expansion going on, and I want to see this expansion continue until we reach, I don't see any good reason for the market to do anything but move to the goals. We've done all the work. We put in the blood, sweat, and tears. We did all that labor yesterday and the day before and this morning, and now we're all done. The story is in, the narrative's clear, the intentions are known. And I just don't think the institutions and stuff should be moving around and doing a whole bunch of things. I think they should be just, okay. I think any action by the bears right now would be detrimental. It would just increase the profits to the bulls. Okay, so we're starting to get this. You see this starting to move up. As things move higher, I expect this to be pretty. I would love to see this just be. We're at 8. If we could get to 12%, that'd be great. That would get us up here. That would show some real aggressive pumping. The bears getting really just pummeled, and we have a good almost 3 days. I'd say maybe 2.5 days, maybe about, because Wednesday was a little messy, worth of people who potentially are getting trapped to get out. So we got plenty of people to pop this up. We could totally pop this up and get this to move higher on Monday. No problem. We have the structure for it. So I don't see any good reason for this to move down into the close. I see good reason for this to just continue to rise. Something else I was noticing that I've been observing for a while, and that today, interesting. I'll just bring this right here. You can see the options prices. I always like options that when price comes down, I like an in the money. So somewhere below price, because I like to own an actual thing. I don't want to own nothing. And that premium, if you add the strike, you take the strike and you add it to the premium, needs to be below the high. So if you had 15 points, cost you 15 points, and that 15 points, so you need a range that's pretty wide, or at least wider than 15 points. So you have a 20-point range, then you could get a 15-point in the money with a strike just below. That way a move back to the high is going to put your position over your break even. It's going to, you're in a position where that you're moving 1-to-1 on your profits. You could sell the market and absolutely hedge all risk, all cost. It's just wide open. All downside moves are just sheer profits. So you want to be able to get to the high and be over the cost. So I was watching today, and one of the things I like 15 points or less with about 2 to 3 days in expiration still to go. So I always look at the 3 and 5. I won't look at the one that expires today because I think, it's just not what I look at. And I'm noticing we're getting these are coming down to that 15 again. And one of the things that I've noticed over this whole pandemic, we just had insane option prices. They're just blown up. They're massive. Obviously, it's volatility, but I like to see 15 or so. Obviously, this is just a hard rule that you do not need to follow. The rule here is just essentially if, whatever your range is in points, your range, we'll just say that's the R. Whatever your range is needs to be a good amount greater. I would say about your premium, your strike plus your premium needs to move up about 2/3 in the range. So you still have 1/3 of the range. So, like here, your strike is here, plus the premium goes there. So if you move back up to the highs, you get a whole third of the range is just sheer profits. This is just the way I think about this. So whatever the ranges are, and the ranges have been pretty wide, I just really like 15. I've been watching options for years and years and years. And it's just 15 is just always the good spot. I used to trade a lot more futures options. I think they're fun. To be honest with you, I think the options are way more fun than outright contracts. But they come with this innate problem, which is that they feel too safe. And so when you execute option positions, you can lose your objectivity because you think that you have gained some discriminatory edge over other traders and that you're somehow not in danger. And that can skew your perspective. It can make you treat, if we have this data point and person A looks at it, they come to conclusion A. But if you're skewed, what that means is that your perspective essentially is over here. So person B who's skewed will look at it and they will come to conclusion B. And the problem here is that you're looking at the same data point and you're coming to the wrong conclusions. And it tends to be that these people will defend, like they'll get offended, which is annoying. I hate it because you always tell somebody's perspective is skewed and screwed up when they get, oh, I can't even believe you would say that, and they get offended. So offense to me tells me that your perspective is skewed for the most part. I don't think of being offended is a good argumentation strategy. I think it's the natural bad perspective oozing out of you like goo. Every time somebody gets offended, you can just go, oh, your perspective's wrong. And you kind of know that. People who have clear heads and good perspectives don't get offended. They just take in information. Nonetheless, when you get skewed, you can both look at the same data point and see the wrong things. And then when your perspective's wrong, you tend to get defensive and entrenched in your bad outcome. And so that's why I think that trading options can be dangerous if you're not careful, because you'll skew, and your skew comes from the feeling of being safe. I can't get stopped out. It's fine. So you've just skewed what risk is. And this has a lot to do with how your perspective operates. Your risk, the way you perceive risk got messed up, so you feel safe, which skews your position, gives you a bad outcome, and it can mess with your ability to be objective. That's obviously not true for everyone. If you do the math with options and you kind of figure out what your real risk is and you model that correctly, then you can not get skewed. But if you just throw an option position on there and you say things like, and I just want everyone in the sound of my voice to know, I hate this term, I wish it would stop. All of you. A lotto, drives me nuts when I hear people say this. I would never buy a lottery ticket, ever. I never have and I never will. It's dumb. And you shouldn't do it in trading. There's no such thing as a lotto. You're not getting a lottery ticket with some high potential profit with some low investment. That's dumb. The market knows what you're doing. It's not secret. It's not obfuscated in any way. It is completely obvious to the market what's happening. So just stop it with this. You shouldn't look to reduce your risk in silly ways. You should look to reduce your risk backed by a better understanding, not because you figured out how to get into the market in a way that doesn't have a stop loss, or you're still losing money either way. And I think people who throw lottos on there, it drives me nuts. There's really only one decent investment or trade at any given time. And so if you're throwing a lotto on there, you're just getting into a position late. You should have done it earlier. You're getting in late and you feel like you're being safe, but really you're just putting whatever you put down on the table at risk, just like you would have with an outright. I think options have their benefits, but they skew your perspective, and that's the problem. And essentially, that's the whole propaganda model. I became familiar with propaganda after trading with options because it became clear to me that skewing my perspective was happening. And then it come to find out that's how propaganda works. We just skew your perspective. And then I don't care what data points you look at because you're going to get it wrong. So I think of options can work that way. It's not that it always has to, but it absolutely can do that to you. And you'll know because options have this fun tendency where if you get an outright, say you went long here, you should have dumped your position. And what is this, like 15 minutes? With an option, you'll get in, if you'd maybe sold a put here, or sorry, you longed a put here, you bought long a put here, you know you screwed up because you're going to hold on to that thing until expiration. This is the thing that drove me nuts, is that you sit in an option position for days, blind. Like the emotions just take over your whole faculty and you're done. And then you're like, after like 2 days of watching some option position just wither away, it all comes crashing down. It's over. And then you're like, what? Where have I been? And you're like a zombie. And it drove me nuts. You do that a couple times and you really have to step back and ask yourself, what am I doing? And if you start documenting your behavior, you realize that options have this way of just zombifying you, and your perspective goes, you think you're objective and you think you're being smart, but really you're going to waste 2 days worth of your brain staring at something you never should have done because you think you're safe. Oh, it can go up against me and it'll come back. It never comes back. Heatwave. So Heatwave just said he's saying he likes to sell options, mainly puts. 3 standard deviations outside. Trying to beat the house, not the gambler. And if it works for you, I never did the statistic stuff. I mean, in the beginning I sort of did, but that's a statistic thing. You're saying statistically the standard deviation, which is the squared average distance, the average squared distance from the average, and then you square root that in the end, and then you take that, multiply it by 3. That's your standard deviation. And it means that 90% of the time it's going to end up in there. That's only true if the market's Brownian. Just if you're getting Brownian motion. So, and the random motion, the reason that standard deviations work is because during times where that the market has Brownian motion, that at all times the market is expected to move back to the mean. So you have the distribution of data points, and that Brownian or random, well, it's collision-based randomness tends to come back to the mean. If it's not random, it doesn't work. But I can see how that and I see what you did there. You're saying, well, I'm selling puts, and hopefully they're 3 standard deviations below the market, because markets tend to rise. So, which I'm pretty sure that's what you're saying. So as long as the market's Brownian, then using standard deviations is an effective way to determine what is high and what is low. If the market has intent, like I think, then the Brownian philosophies or the ugly stop theory falls apart. And that's anytime you're using things like standard deviations, Bollinger Bands, which are standard deviations. You're using moving averages, you're using channels, all those things are built on the Brownian motion philosophy. And so when things get intentional, which ends up being directional, but they get intentional, that those types of things can have some really inherent issues. And that's the problem. That is the fundamental issue that large institutions will tell you, is that you go from states where the market is this to states where it's like this, or states where it's like this. And the problem isn't trading these areas. That's easy. Anyone can do it. It's the transitional points. And so typically institutions for a little while into the next transition lose a bunch of money as it transitions from one volatility to another, from ranging or random to not random, switching. So there's this phase in there. And so one of the things that if you wanted to get a job as an analyst, you could do is you say, well, I can shorten this window. I could reduce that window. And that's what traders, whether you like to think that or not, if you have a moving average, that's what you're trying to do. You're trying to say, oh, crossed over. And you're trying to shorten that window. But anyone who's traded for a long time realizes there's an inherent length of window that you have to deal with. So good analysts can shorten that window of transition from low volatility to high volatility, or shifts in sentiment. And then what a lot of institutions do is just consume options like across the board, and they use those to model those shifts in volatility and stuff. So if you can deal with that, which is what this analysis purports to do, is what I'm trying to do, then you can make serious money, because really there's so much money in those transitions, because that's where even institutional grade people are blowing money into the market, just because everyone struggles with transitioning. Everyone can tell a ranging market, and a 5-year-old could probably sit down and figure out how to trade a ranging market. But when it goes from ranging to trending, or when it goes from ranging to slightly not ranging, all the crazy, that's where everybody gets blown out. So I think that this has some intent to it, and I think that if you're using standard deviations and stuff, you just have to keep in mind the intent, and it'll help you deal with those transitions. And I think it's where the real money is. I don't actually think there is. You could have shorted the high and closed, and bought the low and closed. Sure. But at this moment, you didn't know we were going to continue in a range. And at this moment, you didn't know we were going to continue. And at this moment, so what ends up happening is your risk isn't in defining the structure. That's clear. I mean, that was totally clear. Your risk is in the transition. So if you bought here and you're like, I'm going to close, moves up, you cover. Oh, let's do it again. It never got to your target, and now it stopped you out for just a little bit of loss. Crap. Oh, I lost money. And then it moves up and you're like, okay, here's the range, and you shorted it. It never got to your target. It turned you upside down. And now you took a huge loss. Defining the structure is easy. I mean, you can usually even do that mathematically. It's the transitions that kill you. Build an indicator. I mean, go build an indicator that determines the condition of the market, and you'll find that the thing you struggle with is that the market has this wonderful capacity to somehow know exactly what your code says and break it. I have done it for hours, days, I would say, probably weeks worth of time, trying to build tools that would just define the condition. Are we ranging? Are we not? And what happens is those tools work for a minute or two, a day or two. And then you go, oh my gosh, the market just broke all the logic I'd put in there. And the markets are so good at that. They're just so good at that. Your brain is super good at going range not. But putting that into code, I've found to be extraordinarily difficult. Not because it's difficult, but because the market is cunning. I really do think that what price discovery really is a lot of the times, it says Rice, is not necessarily running for stops. It's taking the logic, if A is B and B is C, then A is C, right? This is logic. Understanding those and just breaking them. And that's price discovery. And my reason for saying that is because I've written so many indicators that just get eaten. You think they work till the market gets its hands on it. And it's crazy because so I think what the market really does in price discovery, if you want my real opinion, is that the motions that you're calling randomness as it hits stops is actually the motion that destroys logic. And logic in this case is essentially it's processes which define markets. Any process that you use to define a market is systematically destroyed, and that is fundamentally price discovery. It is what it is. Go build an indicator or build a tool that looks at price and says, when you do this, and then this, and then this, and then this, you find out really quickly that the market will just break that randomly at any point in time. And it really is a big issue. So yeah. Okay, so we just got up and we hit the first spot, which is that expansion bar right here. Let me mark that. There's a target on this expansion bar, which I thought was useful. Expansion bars are important because expansion bars, when you hit an expansion bar, you're dealing with the inventory. Invent? Wow. You start writing and you realize what you can't spell. Inventory brokers really is what it is. So if price goes like this, it goes up and down and up and down and up and down. You can build inventory at these highs and lows and then basically make a market in the middle to deal with them. So if you had, an inventory, you're essentially going to have something like this. You have longs, this is an L for long, shorts, and then you have positive shorts and negative shorts. Positive longs and negative longs. And this is your inventory. What's important about being a broker is that you are contractually obligated to take bad positions. You guarantee that the people can get filled, essentially. So there are times when your undesirable negatives shoot up through the roof. When you see prices skid down like that, what's happening is that the inventory brokers are being flooded with orders that nobody wants. And so prices essentially skid away because they don't want to fill their inventory with garbage. And so they stop making a market at those prices because they don't want that crap. And then it skids down, and all that's really left in this area here is bad inventory. Which bad inventory basically means they have a want to dump. So it skids down, obviously your negative longs just shot up. So they want to get rid of these losing longs. So naturally, when you get to the expansion bar, they dump that by selling. So they dump a bunch of short orders on the market, and that's why expansion bars tend to bounce, is because the inventory brokers go, they can hedge the position, they can cut it off and move it away and not worry about it. So there's not like a time frame for when you come back to the expansion bar. It's just when they get there, they're going to dump that negative inventory on the market, and that's why they work. That's the whole point. So the market herself knows that there is some, let's say there's X amount of negative longs sitting right here. It knows that. Therefore, if the market gets there, it knows that the opposite, that getting there would cause X amount of compensatory sells. It already knows that. It knows there's liquidity there. It knows that. So that's why I track expansion bars. I think they're a sensible thing to do. I think they make absolutely sense for the structure of the market in terms of inventory. Brokers need to dump those contracts that they didn't want, because they're going to get stuck with a couple of them. But it's not the fact that they're pulling price there. It's just that when you get there, they're going to get rid of their inventory. And that's why expansion bars tend to work as targets and things like that. They also know that if they have an expansion bar here and the market finally gets into point, and at this point they're like, okay, we're moving up. Well, then they'll start to unwind their hedges or stuff like that, or however they do that. And then as it starts to move up, they make a market. So they make the market, and I think it's just how things work. They make the market that gets rid of their bad inventory. So you start bidding the way that you would like it to bid. And I think they all do the same thing. I don't think it's like they're all unique. They are all doing basically the same thing. So, yeah, heat wave save, thus chaos theory. We was talking about the options, where options will grind you out and stuff in crazy ways. So, so we hit that first spot there. There's our spot. I think it pushed up. And did it get to that high? I'm gonna mark it on that. So it did. It got right there. So we got essentially a double top. I think looking at this, we could use to go through that. Let's go through it. We saw some acceleration here right at the beginning. So right here. You see that right there? Let me just make sure, because I mean that's where in my head I had that marked out. I just want to, yeah, it is okay. So as we moved up, that acceleration was popping in right as we moved up here. If these guys are going to liquidate, remember that liquidation has some rules to it. So here's some more. I'm giving you guys this ton of rules here. It has some rules. One is that you're forced to exit now. Okay, so that's really important. It's not something that you choose to do. You're not liquidating if you choose to get out. You're cutting your losses or whatever. So the time drops down to 0. You don't have a choice. And the other thing is that you're unwinding. So you can't get liquidated having your stop loss hit. That's silly. You unwind positions. So you're all over the place in different ways trying to make things happen, and the market pushes your risk tolerance and you're forced to unwind quickly. And it's the unwinding process which has its hands in a bunch of different securities and assets and models and all over the place, stocks. All of these things have to happen at once, which is sort of a pain to do, to get forced out. And the like unwinding process causes the prices to go whoop, because that's when you're unwinding in lots of places, that's what happens. So the liquidation would needed to have been here. And as we moved up, this curled up, but it curled up like as we were moving to the high, not at the high, which makes me think it was not liquidation. It was orders coming in. But it did get up there, and boy, that's close. And yeah. I think this is a response from hitting that there, and the inventory is coming in, dumping down. I don't think that we liquidated the group. I think this was something else. I think that we needed to see that curl up. I want to see this pop up. I want to see it get through there, and then right as it does that, it's like, and I didn't see that. So I don't think we liquidated all these people. I think this is a response of those inventory brokers we were talking about earlier, coming in, dumping their inventory on the market, or rebalancing their portfolio. So we've got 5 minutes left. Anything could happen. So going into, not anything could happen, but in 5 minutes, it's really hard to say exactly what the market wants to do. Are we going to go up, sit here sideways? Don't think we should be pushing down and pressuring through these bullish positions. We got pretty close. There's this rule that if you haven't come across, naturally you will, which is the last point is the most expensive. I have gone through this personally hundreds of times, and I'm sure a lot of you have gone through it too, which is you're at A, you want to get to B, you make it all the way up, and it's 1 point away and does this, and then hits your target. And this was all free and easy, and that last point is like, so I don't anymore, because I don't quite operate the same way anymore. But I used to say, well, what's my targets? What's the obvious target here? And then I would hop out 2 points early. So I'd shave off 2 points and say, instead of dealing with this crap, I'll just take the easy money, hop out early, and let everyone else deal with the nonsense, because that last point is always the most expensive emotionally. Your cortisol levels go through the roof. Your stress levels you have to deal with and stuff. And so I used to do that. I don't do it anymore, but I used to do that a lot when I had other structures for trading. Heat wave profit taking. No, well, yeah, to some degree, I think there's some profit taking going on here. But the thing that I'm watching here is this. I don't see liquidity through here. There's none of that. It could also be, options expiring, some options coming in, expiring. It's Friday. I think there's also an issue with the weekend. So you don't want to hold over the weekend, so you dump your position, which is an absolutely rational thing to do, to say, I don't want to tolerate the weekend. Things went well, I'll just get out. Close is close enough, and dumping. But I think that's probably those things. The weekend's always a tough one. just I think a lot of people do it. In fact, I know a lot of you even heard, I'm sure you've heard this, that a lot of institutions just don't trade Fridays because I think it's just because the weekend, I think for the most part in the morning, the first half of the day, this section here is pretty normal. And then this section of the day on a Friday, people are going to be asking, are we going to deal with this through the weekend? Is this that good? What's going on? And there's probably a lot of phone calls and stuff. What's the news going to be like over the weekend? Are there events? The inside circles show their true face. And so I think a lot of people just dump and just say, I don't want to deal with it when it gets close enough. And this got pretty close, and it looks like that's also going. So I still have the same opinion going into Monday. I'd love to see this market redo what it was trying to do here. We dropped it down. We were able to catch in some bears here, a couple here, here, and now the market needs to retry all this stuff. So if we can trap in some bears on Monday, I think there's a good chance we see this just go. And yeah, pretty much weekend starts at lunch. At least people start thinking. I really don't think they even sort of think about it. Well, okay, so this is a philosophy that I think is important, and that is that when people talk about market efficiency, I think for the most part, everyone gets it wrong. They're under the impression that efficiency has all these. Basically, market efficiency is not a function of speed so much. It is speed, but it's more like the informed traders, institutions, probably more, how readily informed traders can access retailers. This is efficiency, because it's not efficient to say, I can walk into a store and make a purchase. That's been true for years. That's silly. So, oh, your purchase went faster. It's like, how much faster can you get than here's my money, thank you. It's not a transactional speed. That's just silly. It's essentially, how well does a business access the consumers who are all over the community? How well can they round these guys up? You know, things like YouTube, things like Twitter, things like the media. These are really things when it comes to efficiency, meaning the institution can access the retailer quickly. If an institution wants to dump their position, how readily can they stimulate enough people to take the backside of the trade? That's efficiency. And a lot of the times when you hear people measure this, they'll call it liquidity. They'll say, well, how quickly could an institution get in or out of the market? And it's like, well, pretty quickly. They just go to their favorite media source, say something, and they're out. That's efficient. Boy, howdy, that's efficient. If you started a business, you know that if you could tell everyone on the planet about your business, that's efficient. You just told everyone, they all know about you now, and your business is going to go through the roof. You can make your sales. Efficiency is about getting the people who are informed and in control of the market to the people who are used to make the market. This is efficiency. This is what it is at its heart and soul. Now, you could talk about efficiency in terms of processing speeds, but the market's got this throttle mechanism now. You can't slam the bid and stall the market as easily as you used to be able to. It used to be you could put too many bids in there, and then the machines would break, and it would cause this stall in prices, and basically mean there were no prices, and then things would just sort of drop and go to an order 5 points away or something like that. Used to be that was how you could manipulate. Now you can just pump it with as many orders as you can, and it will say the market can only go as fast as the processing capacity of the market, which they should have done in the first place. So you can slow it down, which doesn't give you that drop edge where that you break the market, pen an order, and it goes right to it because you broke everything in the middle. Now you can just slow it down. The reason you slow it down is so you can fill more orders than is physically possible. You're like, I need to fill 1 million shares. How do you fill that in an instant? Well, just slow the market down so the instant is 2 hours. And then everyone's going there, yeah, it was an hour long. This whole range it wasn't an hour long. They were throttling the market. That's what they throttled the market. So like Fox News, yeah, he wait. So efficiency has to do with this transaction here. It's about how well the business can access the clientele and tell them what they want to tell them. And then how well does that clientele believe it and act? That's efficiency. And the market is extremely efficient. This market can tell you anything it wants across the board. Your Twitter, your YouTube, your Facebook, your TV, all the ads, they can pump that narrative to you and instantly see a response within seconds. And I think that's efficiency. So you'll hear people talk about efficiency, and typically what they're talking about is liquid speed, which is how many orders apparently are on the book, which are not always really there. How many are apparently on the book? So an institution tried to get out. That's not how institutions do it, though. They cause the market to stimulate the traders, and they fill against them. So this whole order book philosophy that people use as a liquid metric is just silly. It's silly. It ends up not working at all. You're sitting there going, well, it's very liquid. Where are all the institutions? Because that's not how they work. This isn't a machine that's random and out of the, it's completely in their control. So that's what I think liquidity is. All right, so the market has closed. My expectation is to see the bulls give this a go tomorrow. And now, now at this point, you can start to see it taking shape. I think a lot of bears are going to see this. There's going to be some issues with them. I think there's a good precedent here to see this move up. I would love to see some new highs. And for me, new highs is anything above this right here. So I'd love to see the market get up there on Monday, get through those levels and just go. That's what I think I'm anticipating. So that's where I'm at. All right, the market is closed. Go do something else. That's what I'm going to go not think about the market for like 2 hours. If anybody has questions, shoot me questions over on Twitter, Discord. I'll do my best to answer them. Otherwise, have a great weekend, guys. Bye.